another episode of Corporate CPR, where we breathe life back into your organization, projects, and processes, giving you insights to recovery and avoiding corporate mortality events. Today, we'll be talking about preparing for IPOs and how that can impact your employee retention. And joining us to contribute to the conversation is Aaron Rubin. Welcome, Aaron.
Great to be here.
Can you share a little bit about your background with the audience?
Yeah, sure. So I'm a CPA and I am a California attorney and I am a certified financial planner. And my business revolves around helping individuals at pre-IPO companies make good decisions with their stock compensation. And that can include thinking about before you join a firm, what should your stock comp or equity comp look like, and syncing up with attorneys and all that sort of thing. So do a lot of different things with our business.
Oh, sounds great. Well, so we're going to be talking a little bit about corporations preparing for IPOs, and then tying that then to how you've got to keep your employees in mind, and I guess to your point, what can we in the end, or what can employees be looking for as well, so they make good decisions about what companies they enter. But let's start at the high level and talking about these companies who are looking to go through IPOs. I mean, when do they start thinking about it, and what should they be thinking about in order to have a successful one?
Yeah, so I mean, it's getting later and later, to be honest with you. And actually in 2022, when you and I here are talking, there's virtually no IPO activity happening almost whatsoever. The whole thing is basically dried up. For large IPOs anyway. There's a couple, super small ones trying to raise a couple $1 million, but none of the the blockbuster ones that we saw in 2021. There's actually over 1,100 IPOs that happened this year. I think we're a few hundred in, and everyone's saying that it is not improving anytime soon. So if you're looking to go IPO in 2022, fantastic. But I think when do people do it? People like to wait, and I get to talk to a lot of C-level executives out there, and I think what the general consensus is that being a public company is horrible in so many respects. It gives you liquidity, but now all of a sudden you have all these shareholders and there's a lot more obligations on you, and you're responsible to a whole new group of people. And so companies do their best to wait as long as they can, right? We used to have this concept of unicorn companies, and probably a lot of your listeners know, right? Those are companies that are valued over $1 billion. And they were called unicorns because they were so rare. And now being a unicorn is nothing special, right? We can look out there and we see, companies that are decacorns, right? They're $10 billion companies. And so companies tend to wait as long as they can. Usually there's some sort of, well, they could be trying to raise large sums of money, on the public market, but a lot of times, a lot of the stakeholders are looking for liquidity as well. So there can be rumblings because of that. So,
So
when to look for it. But
what usually then is the precipice for a company going IPO? I mean, like you said, the traditional one I think most of us hear about is the raising funds, but are there some key triggers that when a company should consider becoming public?
um, I it's one of those things where you sort of test the waters, with your VCs and the banks, and decide what's in the best interest of everybody. What is there a particular trigger point? No, I don't actually know. Raising money, of course, is the big idea, right? You want to raise, a significant amount of money to expand your business, which is why companies go public. But again, a lot of times, I think sometimes there's pressure, from outside forces.
Mm-hmm. Interesting. And so if a company does some of the work you do then involve companies who maybe aren't going IPO but want to create kind of that same employee ownership then within their companies, like using phantom stock or restricted stock units or things like that. Do you see companies doing that instead of actually going public, so that they're sharing their company's success with their employees, or have you not seen a lot?
That's almost always part of the packages, right? As as if you want to attract talent, right, you have to offer them something, that they can't get, somewhere else at like a Google or, some of the more established companies. So the first and foremost, right, when you're a younger company, again, that could be, prior to your D round, you're typically offering more in terms of stock options, whether those are non-qualified stock options or incentive stock options. As you mature and as you really get close to that IPO date, a lot of companies start to shy away from that. And so then they'll start offering, the double trigger RSUs, a key, which is sort of a class of phantom stock, but that true phantom stock, or which I think most people think of as the stock appreciation rights. You know, I don't see that as much. I've seen it, but just not as much. So again, people want, I say people, companies want to keep their people engaged. And I can't tell you how many clients I talk to. Again, I work with individuals, not the companies themselves. So I can't tell you how many individuals, come to me and say, "Man, when this company goes public, I am out." Or it's, "Hey, yeah, I'm gonna leave my company, but hey, my next vest is coming up in like 3 months, so I'm sticking around for 3 months." So again, equity compensation, I think, is really important. One, to attract talent. Two, to retain, the people that you have.
Mm. And so I guess, have you seen, like, going back to more on the corporate side, then have you seen instances where then companies have kind of gotten it wrong when they've done their IPO? And if you get it wrong, what does that mean and what does that
Yeah.
do to the company?
Yeah, I think, companies, I think, typically have pretty decent lawyers.
Mm,
So they protect themselves, quite well. But we've seen a lot of negative press, from, companies like Skype. When they sold off to Microsoft, all their employees had clauses in their stock agreements that said that essentially all stock could be bought back at par, sort of what they paid for it. Um, and so, what happened was right before the deal closed, they bought all the stock back so that none of the employees actually got the benefit of, of that Microsoft purchase. They didn't get, sort of what they thought they were getting. And so again, that leads to, again, Microsoft probably doesn't care. It's Microsoft. What are you going to do? Not use Windows?
mm,
But certainly you look at, places like Uber, right? So Uber, when it went IPO, it changed its structure for vesting on its RSUs, so that the RSUs actually vested on the first day of trading, as opposed to when the employees could sell the stock. So they accelerated the vesting to day one of the IPO. And so what happened was, on that, because they're all double trigger, they all of these people who have been accumulating RSUs for, maybe 2-3 years, all of a sudden all of their RSUs vested on one day, and that one day was the day that the company went public, which, sounds like it's not a bad deal.
mm,
But what happened was, the when you get vested RSUs, you have to sell a certain amount to cover the tax. And the
mhm,
tax is, it's comprised of payroll tax, it's comprised of state, and it's comprised of federal. But through nuances within the withholding system, um, usually those RSUs are taxed at what's called the supplemental rate, which is 25%. And many of the employees were at well beyond 25% rates of taxation. And so they were all under withheld when their stock vested, which is normally not a big deal. But the problem is, the stock price went down. And so so they all got tagged with the tax when their stock was high, but then they needed to come up with additional tax payments, which they needed to sell the stock when the stock was low. So they were forced to sell low when they didn't want to.
mm,
And the problem is that leaves a really bad taste, in your employees' mouths. They
right.
don't forget that, right? They were really excited about this big payday, and then all of a sudden, it's like, oh my gosh, I owe this tax, and I have to sell my stock low, and no one wants to do that.
Hmm. Wow. And so I would assume it wasn't necessarily intentional. I suppose on the part of Microsoft, they probably, I don't know, thought their stock was going to go up or something like that, Or was this
Yeah,
something?
well, yeah, well, well, there's two different cases, right?
Mhm.
I cannot assign malintent to anybody.
Mm.
And being a lawyer, I would never do so in a public forum. Um, but it was pretty rotten what Skype did, and that
Mm.
whole transaction really smelled bad.
Mm.
Um, the Uber thing, they were really trying to do right by their employees, right? Because I mean, I guarantee you what everyone I do, because I assure you they're all very bullish on Uber stock, or they were bullish on Uber stock, and they thought, oh, we are gonna make our people so much money because we're gonna have it all vest on day one, and then the stock's going to go up by like
Right,
30%.
right, right.
So we're going to give them a really good deal. And then when they go to sell their stock to cover the tax, well, gosh, they're going to be so happy that they made so much money, that, it's going to be great. And of course didn't quite work out that way.
Mm. Yeah. And so, I mean, that does, there's a lot of complicated pieces to work through from a tax perspective, what's even legal perspective, and yeah, and so, I mean, are there other kind of key pitfall areas that companies should be looking out for then to, make sure that it's a win-win situation for all parties involved?
Yeah, and we're definitely seeing improvement in some parts of strategy around the equity compensation for people at the company. So it used to be a lot more rare to have early exercise available for individuals at companies. So early exercise is when the stock isn't vested yet, but you can buy it ahead of time, essentially, and then as it vests, it's already prepaid.
Mm.
And there's definite stock, there's definite tax advantages to doing that. And I'd say a couple of years ago it was more rare, more. And again, what and this is just to let the people who are listening to the podcast know, when a person comes to me and says, hey, I just want to let you know that I switched jobs and I'm getting this new stock comp package, I'm getting 90,000 shares or 100,000 shares, whatever it is, I immediately say, okay, well, tell you what, why don't you ask them if you can early exercise that stock. Again, that's sort of the first thing as an advisor that you do. um, and it's becoming more and more common that the answer is yes, I can. So I think that's
Mm.
fantastic. So I think if you want to help your people out, I think allowing early exercise is a good thing.
Mm.
The other thing that we see, and I don't know if it's more, but that we see is use of what's called 10b5-1 plans.
Mhm.
And those are non-discretionary plans to sell your stock when you're otherwise in a blackout window. Um, and I don't know if you're familiar with that, or maybe your listeners may or may not be, but essentially, you have stock, then you're an insider, or maybe you're subject to, you're part of management, so you've open and closed windows for which you can sell stock. And so, during an open window period, you can set up a plan that says, hey, by the way, if at any point during this year the stock hits $50 a share, or whatever the number is, sell 25% of my holdings. And so again, that's the non-discretionary part of it. And so if you do that during an open window, and let's say the stock hits your target, your $30 a share during a closed window, it automatically sells and you get the benefit that you were really hoping for.
Mhm.
So again, offering 10b5-1 plans to people, as many people as you can, is a good thing. A lot of companies don't give it to people who are not as high up in the organization, because they have to be administered, and it's a pain.
Mm.
But again, I think if you want to do right, by your employees, I think having a 10b5-1 is a major sales point. If you're an employer and you're in your C or D round, and you're anticipating having a 10b5-1, or maybe you are public already, and you can tell your candidates, hey, by the way, I want to let you know that one of the things that we have for people in your position is, you can sell your stock, on a stock plan if you want. And again, I think that's a big selling point. Um, and so early exercise, 10b5-1 plans, um, I think are the big ones,
Mm.
that we look for when someone says, hey, I just switched jobs.
And from have there been any like great success stories then of IPOs and how things it was set up, and where, I guess maybe even employees really did win when the company went IPO?
Yeah, there are, and you know, some of it depends on the kind of IPO it is. So for instance, I'll use so Coinbase is a good example where employees really did well. Um, and and again, I have no opinion about Coinbase, you know, whatsoever, but I will tell you that I spoke to multiple people who worked at Coinbase before they went public. And they told me, hey, the first day I can sell, I'm selling all my shares. Because they just didn't want their fates tied to the crypto market. That was not that they didn't believe in the company, but they just realized that Bitcoin was highly tied
Oh,
to Coinbase's success.
my dad used to say you don't want to be long your job and long your company stock. So he actually used to always encourage me to exercise and get rid of my stock, because it, like, or at least balance out your portfolio, because if you're getting paid your 100 grand or whatever, that's basically an investment, right? That you're investing in the company. And then if you have
Yeah.
stock in your company, now you've got a lot of eggs in that basket.
Yeah. I mean, you can ask the Enron employees, right?
Right.
How that goes.
Yeah.
Um, you know, so certainly having a strategy like that, and your dad and I are kindred spirits. You know, and again, it's sometimes it can be hard to get people off, you know, their position um
Mm.
of being very bullish on their stocks. Coinbase was not one of those, by the way. But a lot of people are like, oh yeah, this stock's going up to, let's say it's in the 30s. Yeah, it's just this stock's going to 200 in the next couple of years. It's like, maybe, I hope, you know, but yeah, it's especially if you're one of the people, if you have a lot of stock that's still unvested, right?
Mhm.
You have plenty of upside, you know, that's okay. You know, keep your upside that's unvested, but take your vested upside and start thinking about, well, what if I'm wrong? You know what, you know, how can I improve my life or you know, improve my kids' lives, depending on what your situation is, by selling some of this and
Right.
sort of solidifying parts of my life, my financial plan. But in Coinbase's case, you know, a lot of those people went. So Coinbase was a direct listing, which is different than an IPO,
Mm.
because a direct listing, there's no underwriters involved, there's no banks involved. They just send out the shares on day one for people to buy. And so as a result, because there's no bankers or syndicates, anything like that, um, the employees can generally sell on day one, and a lot of people did. A lot of people just sold tons and tons of stock. So the stock came out at like 250 a share. It got up to like somewhere in the low 300s, I think. You know, midday on that day, and there's a lot of people made a lot of money. And again, that was the direct listing structure, which allowed them to sell early. We've had a number of clients throughout the years, and I commend companies for doing this, where they'll let the person sell, and usually it's like 25% on day. It may not be day one, but somewhere within shortly after day one, maybe it's after the first earnings call, they can sell 25%. And then after the second earnings call, they can sell another 25%. And then after 6 months, then they can sell the rest of it if they want to. But giving your employees an escape hatch early on, I think, is a very sensible thing to do.
Mm.
Again, a lot of the people that are working for these companies, they've put in so much time and so much energy, and they've taken tremendous amount of risk.
Mhm.
And I think to reward them with something like that, I think is very appropriate.
Do you think that, there's been, and I guess this might be going a little bit outside of your knowledge area, so forgive me if I'm putting you on the spot, but I have a lot of skepticism. So let me rephrase. Like having, giving employees like some sort of ownership when you're going to take a company IPO, or you think you're going to sell your company to a bigger company or something where there's going to be an event. I can see that being very motivating. But if you're working for, say, Microsoft right now or Google, do you think that the employee stock program, or the stock option programs, are really that incentivizing to employees, or is it it is once you get to a certain level and you're getting large amounts of stock options versus the people at, maybe the lower levels who you're getting like 10,000 a year or something, and it just doesn't seem like that much.
Yeah, I think there's definitely there's at least short-term incentives, right?
Mm.
If basically, I mean, essentially, what's an RSU? An RSU is a bonus. That's all it is. It's a bonus that's paid out in stock, as opposed to being paid out in cash. And and so for a lot of people, they will wait for that bonus. So instead of jumping ship early, again, and it could be they're waiting. Maybe they are waiting for a couple of years because maybe the big vest happens, at a particular point, or maybe they're performance stock units. Or the other side of it is maybe the company, all of a sudden the shares keep jumping up in value, and and the 20 shares that were worth $6,000 when they were granted to you 4 years ago, well, now they're worth 10x. Well,
Right.
that's a little more enticing.
Hmm.
So again, I think as companies do well, I think it does keep people in their seats for at least a little bit of time. Now, if someone's truly not happy, they're not going to gut it out for decades, right? But I do think that there is some benefit to it.
Mm.
Again, I mean, if you have a crappy culture, no one wants to stick around.
Right, right.
Uh, so I mean, they'll wait till the next vest, and then they'll bounce as soon as they can. Yeah, I've not seen the data, but I'm going to assume like Apple pays out I think their RSUs in February and then August or September, February, no, August. And I guarantee you, the rate of quitting, probably increases dramatically, in those months, because people, have waited for the next vest.
Mm-hmm. And so I guess what are some, have you seen any, I guess, obviously this is a highly regulated area, and so there may not be a lot of creativity allowed, but but if there is, like, have you ever seen any like sort of really interesting or creative ways that companies have designed these things, uh that really engaged employees or something like that?
I, Obviously, the younger the company, the more flexibility you sort of have.
Mhm.
As you take on additional funding rounds, more restrictions end up happening, to your stock. So early on, in your A round, your seed round, you might be able to move stock into different trusts, right? To Again, if it's early enough, you can get qualified small business stock treatment, right? Which is $10 million tax-free gains,
Mm.
per person. So if you split it up between trust, you can amplify those sorts of things. Now, once the company becomes much more mature, it becomes much more hard. It becomes much more harder. It becomes harder to start moving those stocks because there's just more restrictions that happen.
Mhm.
Um, so so creatively, yeah, I think, especially younger companies, they will do what's called RSAs as opposed to RSUs, which are, they sound the same, but they actually have a couple really key differences. And the RSAs, you can do that, well, it's not an early exercise. You can do what's called an 83B election. You can get taxed on it when it's worth nothing, and then hopefully in 5 years, when it all vests, all of a sudden it's worth lots of money, and you've avoided paying some tax along the way. So again, but again, those are for less mature companies. The more
Mhm.
mature you get, the harder it is. So definitely, using RSAs in there, allowing early exercise for people. Those are some big things.
And so what are, like, I guess, turning then to the individual, like, what are some recommendations when companies, or maybe when people are looking for their next gig, that they should be asking?
Yeah, I think that if you're looking for your next gig and you're, senior engineer above director, whatever it might be, VP or C level, I think, there are attorneys out there that will help you negotiate that next comp package. And if you've been established as a startup, and if you've proven that, you have real value, negotiating those points are important. So we work with an attorney, her name is Mary Russell, and she works in the Bay Area helping people just do that, negotiate their comp packages. And so, don't waste that opportunity, because you need to know if your stock comp package says that they can buy you out at par. That's important. And I helped someone with that too. There was a guy who, was a key employee it was an LLC, and they decided, hey, we really want to ramp this up. We're going to go to a C Corp. We're going to issue stock. And he was going to be the key guy. And he said, hey, would you mind looking over this agreement for me? I said, oh, sure. Yeah, I mean, I'm not going to do a legal opinion for you, but I'll tell you, hey, by the way, this says that they can purchase the stock back for whatever they want, whenever they want. So
Mm,
you don't really have anything. you have the promise of maybe having something someday if they decide that they want to let you have it, which is not where you want to be. So as you move up, having someone help you on that, I think is really important. And then getting the right tax advice too.
mm. And how much, I guess, how much flexibility do you find that companies then actually have? Like, or how much room is there actually to negotiate on some of this? Is it pretty rigid, or,
Yeah. And again, it goes back to that size of the company, right? Negotiating with Microsoft is different than negotiating with a company that just got their B round, and you can call more shots on the B round as opposed to Microsoft, who, they got plenty of people that they can find to work for them. So
right?
again, it all depends.
Hmm. And so what are some of the other, I guess, key, things that you've seen out there that, people should be, I guess, taking into consideration, or any other anecdotes that help us navigate through this field?
Yeah, I mean, I think I've seen the IPO process go really well for people, and I've seen it go not so great.
Mm,
Um, Data suggests, again, that so there's a group out there that aggregates all IPO data from 1980 through present day. So I mean, it goes through thousands and thousands of IPOs, and the day one return on an IPO is ridiculous. The average day one return, it's enormous.
mm,
When you look at the 1 year data, the 5 year, or 3 to 5, IPO stocks, new companies, tend to underperform their peers who are not who are more mature. So again, when we look at that sort of thing, you have to say, well, okay, again, and it's gone both ways, right? Because I've seen it where people have said, I'm not selling my stock, and it goes up by 50%, and they're really happy. And I've seen people say, well, I'm not selling my stock, and it goes down by 50%, and they're super angry that they didn't sell their stock earlier. So again, the part of it is you have to underwrite your own company, right? You have to be honest with yourself, and that's I think the hardest part of it. For people who are trying to make decision of, oh, do I want to keep this stock? Well, I think it's going to go to 200. Do you really? How much do you know? Do you know enough to know that, or is the CFO telling you that because that's what he thinks? And maybe he knows something, or maybe he's just really optimistic, or not. Yeah, again, it's so I think being honest with yourself is super important. And I think looking at your own financial situation and saying, what do I need to do to secure my future? Again, your company's gonna, is gonna do their thing, and you need to take care of yourself. So, if you can take half of your stock, sell it for $4 or $5 million, and essentially set your retirement up for almost the rest of your life, depending on how much you spend. But if it's only going to take a couple $1,000,000, and you can secure your future, you do it. You might lose out on some of the upside, but are you really going to be angry if instead of having $50 million, you only have $30 million. Is that really like life shattering? I don't think so. So yeah, I think I'm a big proponent of taking off the table when you can. You don't have to remove it all, but again, secure your life, secure your kids' lives, and be happy.
Hmm. Absolutely. And then I guess what about any other recommendations then on the corporate side then, when you think about how you want to keep your employees and what they are there kind of key, is there a framework or questions they should be asking, to set this up in a way that's going to win for everybody?
I would say, education is your friend for your candidates who you're going to hire. And if you could tell them, it's one thing to tell them, hey, we have early exercise. It's another thing to show them, hey, this is the real benefit to that. Like, you might make a lot more money, as a result. Or hey, we allow 10b5-1 plans, if you ever, if you ever want to plan to buy a house, but you're an insider, we can set up a plan for you that, hey, you can get the money out when you need it, as opposed to waiting for your window to open whenever that might be.
Hmm.
So again, I would say, for on the company side, one, make sure you have the features that are helpful to employees, which to me are early exercise, 10b5-1, which are sort of the big two, and then advertise the heck out of it. Let people know, like, hey, being part of our culture means that we take care of you, and taking care of you means that you can sell your stock, when's appropriate, and you can lower your taxes if you want to,
Hmm.
and I think letting people know is important.
Okay. Well, this has been a really interesting conversation, Aaron. I know we've kind of recapped a few things, but are there, kind of three things you want to leave top of mind for people?
Yeah, the I'd say there's a couple, and that one is think about early exercise and think about 83B elections. 83B elections basically allows you to, when you early exercise, you can get taxed on the difference between the fair market value and the grant price, which when you're hired is typically the same thing. So you get taxed on zero. But you have a 30-day window to file that 83B election. So if you're going to early exercise, make sure that you have your ducks in a row, on that one, or else you're going to lose it and it'll all be for nothing. Um, the other thing, and it's kind of the corollary to that, is go get tax help. And you might end up paying a CPA, $1,000 to analyze whether or not you should really do the early exercise, or what the best route is for you for any given decision. It's worth the money, because you could be saving hundreds of thousands, millions of dollars, depending on your situation. Get your tax help, get it early. I can't tell you how many people I've talked to who they have, you know, 10, 20, 30 plus $1 million in stock, who do their returns on TurboTax. Like at that point, it's not appropriate anymore. You need to graduate to getting a CPA who really knows what they're doing. Um, and again, you go for expertise. Don't go on price. Make sure that the person knows what they're doing. So, and obviously, and I mean, and it doesn't have to be like Deloitte, and it doesn't have to be Ernst and Young. There are lots of really great regional firms that'll take your return on. I mean, it's a couple thousand, usually, maybe even more. But again, you don't want to go like bottom of the barrel, like H&R Block,
Mm,
to plan out your $1 million transaction.
right. Yeah.
Go for quality. And then once you get to that point of, hey, I need a strategy, talk to a financial planner,
Mhm.
who works in the space. So I mean, obviously we like us, but there's lots of planners out there, who have experience that could help you out.
All right, great. And where can folks get in touch with you or learn more about what you do?
Oh, all over the place. So obviously, we have a website that has a blog, and our blog is very focused on stock options and pre-IPO stock.
Mm,
So you can check out that. We're obviously on Facebook. How could you not be? And Twitter, we're WRP Wealth, and LinkedIn, and then we started TikToking not that long ago. So we have a
Nice.
TikTok account, IPO Graphs. That's our handle, IPO Graphs. So
All right.
we put graphs on. We talk about the last 3 videos we've done have just been talking about the alternative minimum tax, which is as fun as you think it is.
I'm sure it is. Can't wait. Well, thank you so much for your time, Aaron.
All right, great to be here.
And to our audience, until next time, keep your organizations healthy.
Hey! Short tomorrow.